Hey investing friends. In this special portfolio update, I review my $196,000 dividend growth portfolio for the month of December, as well as the year-end performance. Let's do this. Welcome to Mr. Financial, where I share my investment journey to financial freedom, which is about 14 months away for me now. I'm excited to bring you a year-end update at the end of the video, as well as a recap of how the markets performed. And the one stock I bought a freaking ton of the past few months. For those that follow me on Blossom Social, you know what I'm talking about. If you're not already using that free app, just use my link in the description to download and join the hottest social investing community out there, guys. I'm gonna kick things off with what used to be my smallest position, Go Easy Ltd. It ended the year with a weighting of 5.5% of my portfolio in the consumer finance industry as my sixth largest position. This was 0.5% in October, and I completed a second tranche in November and a third in December. The share price just plummeted with some serious selling pressure. I'm a little disappointed I didn't take full advantage of the 2 years I had to build this position out in my buy zone from January 2022 to January 2024. I got caught up on wanting to sell Fiera Capital Corp first, and I shouldn't have. Go Easy finished the year up 11%. This is a great lesson for new and experienced investors alike. When a company hits your buy zone, buy it! Buy out that position without hesitation. I did so with CPX in January of 2024, and I should have done the same with Go Easy. Nevertheless, I added to the 13 shares I bought in November, buying an additional 45 shares at an average price of $159.75. That added $210.60 to our annual dividend income at a yield of 2.9%. Next is my new smallest position, MCAN Financial. It represents just 2% of my portfolio. MCAN hit its all-time high in the beginning of December, only to fall off a cliff over the next 10 trading days, dropping about 10%. Its fundamentals remain strong, with its dividend coverage in great shape and record-setting mortgage portfolio as we saw in Q4. MCAN Financial finished the year up 26%. Not bad for a sector that hasn't fully popped yet. Next is another small position at 2.3% of my portfolio with TD Bank. They reported Q4 at the beginning of December, and it provided some relief for the constantly dropping share price. Here's some of the highlights. Adjusted earnings were down 8%. CET1 capital ratio decreased to 13.1%. The AML issue, as we know it, is dealt with. However, there is a lot TD is working on that will take 3 to 4 years to work out, as you can see on the timeline of events here. With all that in mind, it's no wonder that TD admitted 2025 will be challenging and is suspending the medium-term financial targets that will be updated in mid-2025. TD finished the year down 6%. My 13th largest position, also with a weighting of 2.3%, is BCE Inc. This is now down over 38%, and as of last quarterly report, the dividend is still not being covered by free cash flow. With the debt that they are currently carrying, it's hard to see how, in short order, they can start to pay down the debt and cover their hefty dividend payout. In my eyes, non-core assets should have been sold and used to pay down the debt, as well as a modest dividend cut to anchor their financial position. But who am I anyway? Just another dude on the internet. BCE Inc. finished the year down 31%. Next up is a massively growing position, Brookfield Corporation. It represents 3.9% of my portfolio. If only I had doubled this position size back in 2023 when it was trading in the low 40s. It finished the year strong, up 60%. My 11th largest position at 4% of my portfolio is Fortis. The utility sector has done very well in 2024, especially in Canada. It finished the year up 14%. Considering the TSX finished the year up 21%, this underperformed on a yearly basis compared to the index. However, it was right in line with the sector. Again, looking at yearly performance is cool and all, but not the end-all, be-all. I don't make my investment decisions based on a yearly total return. Stock returns, much like the leg of prosciutto, has to be looked at as a whole and not a single slice of that whole. Next in my portfolio is Telus Corporation. It has a weighting of 4.2%. Telus has been steadily dropping in its weighting because of its plummeting share price. I haven't bought shares in the $19 to $20 range since I grabbed a few in March 2020 during COVID. Considering Telus finished the year down 11%, it was the best of the worst when compared to the other big three, and it was better than the sector performance of negative 21%. We nibbled 3 shares at an average price of $19.30. That added $4.83 to my dividend income at a yield of 8.3%. My 10th largest holding is Pembina Pipeline Corp at 4.6% of my portfolio. I haven't added to this position in over a year. Midstream pipelines is a more stable industry in the energy sector since it really isn't dependent on commodity prices at all. With the potential of the US increasing production, this should be good for Canadian pipelines as the US imports a lot of oil from Canada. Pembina finished the year up 23%, in line with the sector performance. Let's see what the new year brings to oil and gas in Canada. Our 9th stock by portfolio weight is Manulife Financial Corporation at 5% of my portfolio. Manulife pulled back a little before the end of the year, and yet it still finished the year up 58%. The financial sector was up 30% on the year, so this is quite exceptional and isn't isolated to Manulife in the diversified insurance industry, with many companies up over 50% on the year. My 8th largest position is SmartCentres Real Estate Investment Trust at 5% of my portfolio. Real estate is one of the few sectors that just sucked in 2024 for the TSX. It was up a whole 5.5%, the second worst performing sector. SmartCentres finished the year up 6%, in line with the sector. Real estate is struggling across the board, from residential, commercial, industrial, you name it. Next is my second midstream pipeline, Enbridge, with a weighting of 5.7% of my portfolio. As I mentioned for Pembina Pipeline, the energy sector did well on the year, and Enbridge was a standout. It finished the year up 35%, beating the sector and index performance. There is still a runway for Enbridge here. There was a lot of negativity around Enbridge when it was trading in the mid-40s. Now that it's trading near all-time highs again, Enbridge is back in favor with the street. Go figure. Jumping to my 5th largest position comes Bank of Nova Scotia. It represents 6.4% of my portfolio. It finished the year up 30%, in line with the sector. Scotiabank was helped by the fact that it was coming from such underperformance and was in deep value territory. The same can be said of the best performing bank in CIBC. BNS reported Q4 at the beginning of December. Here's some of the highlights from that report. Quarter over quarter, EPS is down 4%, revenue flat, yet year over year, adjusted EPS is up 28% and revenue up 8%. Looking at this slide, you can see how Global Wealth Management had the largest gain at 13%. On the negative side, allowances for credit loss are quite stable and total PCLs are down, yet the number impaired is about 25% higher, all in the Canadian banking side, which is no bueno. Mortgage renewals are going to start to ramp up this year, peaking in 2027. It'll be interesting to see how the financial sector navigates the lowering rates and less employment in Canada. My 4th largest position is TC Energy Corp. It has a weighting of 6.6% of my portfolio. This is my biggest of the 3 pipelines and had by far the best yearly performance. It finished the year up 48%. You heard that, 48%. Much like Bank of Nova Scotia, this was in deep value territory since summer of 2023. It was only a matter of time before it returned to its historical averages. My 3rd largest position is another REIT, RioCan Real Estate Investment Trust. It has a weighting of 7.2% of my portfolio. Remember, real estate returned a measly 5.5% in 2024. How did RioCan fare? 4%, not even returning its distribution yield. I am looking forward to the future as RioCan is well placed in the market to take advantage of its best-in-class properties. I bought 4 shares at a price of $18.11. This added $4.44 to our annual dividend income at a yield of 6.1%. Next, my 2nd largest position is a monthly financial payer, First National Financial. It has a weighting of 7% of my portfolio. First National Financial finished the year up 13%, and that includes the special dividend of 50 cents. It was up over 25% at one point at the end of November before pulling back 10% before the end of the year. That was much more than the TSX did as a whole. Large swings in price are more common with First National than MCAN, with a beta of 1.11. And lastly, the beast in the portfolio, Capital Power Corp. It has a weighting of 13.9% of my portfolio. How did Capital Power Corp perform on the year? It finished the year up 77%. Remember, utilities as a sector were up 13%. At one point, CPX was up 86% on the year before it pulled back just at the end of the year. Capital Power Corp is well positioned as a mid-cap, almost large-cap stock. I'm very happy I built this position out at the end of 2023, start of 2024. This is the opposite of Go Easy Financial, where I tranched into my full position right away. And lastly, I have one ETF that is basically negligible. Man, I can't speak English anymore. VFV, Vanguard's non-hedged S&P 500 Index ETF. It remains unchanged at 0.2% of my portfolio, with the whole 2 shares that I've owned for quite some time now. The S&P finished the year up 36% on a Canadian dollar basis, and VFV was nearly that. I did way more buying this month than I did the previous 2 months. I deployed a total of $7,319.09. This added $219.87 to my annual dividend income at a yield of 3%. I maintain a diversified portfolio of 16 individual stocks and 1 ETF. Here's the industry breakdown of my TFSA as of December 31st. Diversified banks make up 8.7%. Midstream oil and gas make up the largest at 16.9%. Regulated electric utilities make up 4%. Retail REITs make up 12.2%. Telecom services make up 16.5%. Life and health insurance makes up 5%. Independent power producers make up 13.9%. Asset management makes up 3.9%. Consumer finance makes up 5.5%. The S&P 500 makes up 0.2%. And mortgage finance makes up 9% of my portfolio. Again, you probably noticed that doesn't add up to 100%. That's because the rest is sitting in cash. Literally, the ticker cash, a lot of cash. I started the year with a portfolio size of $128,000. I added $24,000 of cash to the account, received $9,200 in dividends and distributions, and finished the year nearly at $200,000 with a portfolio return of 29% on the year. I was sitting at 36% before the market really pulled back at the end of the year. So how did that stack up to some of the benchmarks? Canadian utilities finished the year on the upside. The S&P/TSX Composite and the S&P TSX 60 increased 21.7% and 21% respectively. Regardless of a pullback in December, U.S. equity markets experienced an epic year in 2024, characterized by 57 all-time closing highs, with the S&P 500 finishing up 36.2% on a CAD basis, closing out the best 2-year run since 1998. The S&P 500 top 50 finished the year even stronger, up 45.8%, driven by mega cap strength, robust economic growth, and, you know it, AI-related optimism. Although mid and small caps benefited from the broadening of the rally, amplified by the presidential election results as enthusiasm ensued for domestically sensitive stocks, inflation jitters and fewer than expected Fed rate cuts led to their recent stark underperformance. The S&P Mid-Cap 400 and S&P Small-Cap 600 were up 24.1% and 19.4% for the year, respectively, lagging their large-cap peers in Canadian dollars. The US dollar finished the year up 9%. So there you have my year-end recap for my TFSA. Let me know how you did for the year in the comments below. Thank you so much for watching, all you lovely people. Until next time, I'm Mr. Financial.